upkeep on the property.
Correct.
You're also putting a lot into that property every month in terms of, that potentially would be covered by a landlord or, in another situation.
Maintenance, rates and taxes.
When we think about investing, you often hear terms in the industry like discretionary investments versus retirement investments. And I heard, Kelin, you describe the tax-free savings account as a kind of new kid on the block.
I mean, a tax-free savings account, it's an amazing instrument that was introduced by National Treasury in 2015. And surprisingly, there aren't a lot of South Africans using it.
First off, I think that a tax-free savings account is a great investment product. I do think that it should be considered with an RA. So I don't think you should be sort of selecting a tax-free savings instead of a retirement annuity. I think both have a place in one's portfolio.
Welcome to the first edition of the Rands Sense vodcast. You guys are our first guests, which is amazing. Thank you for being here. I'm going to kick introductions over to you, and then we'll come back and we'll have a chat about some issues affecting South Africans and their money.
Cool. Thanks, Carl. I'm Bianca. I'm a portfolio manager at 10X Investments. And what that means is that I look after the portfolios, and I'm quite interested in making sure that we have the right technology to manage the money efficiently.
I'm Kelin Pottier. I'm a solution strategist at 10X in our investment team. In very simple terms, I'm responsible for coming up with investment solutions to help our clients achieve their life goals, really, and making sure that we continue to serve the needs of our clients in the best way we can.
It's nice that you say that, because actually the stated aim of this whole setup and why we're here today is to bring transparency to the decisions that affect those life goals, right? There are certain decisions everyone has to make, whether you're South African or not, but we'll be talking about the South African context here. But everyone has to make decisions, financial decisions, investment decisions that affect their whole lives and their families' lives. And if there's one thing that our industry is notorious for, it can be making those decisions perhaps more difficult than they need to be, or at least not as clear and transparent as they could be. So one of the things we're trying to achieve with the setup with Rands Sense is bringing that transparency and that clarity to these decisions. We're not telling people what to do. We're definitely not offering advice, but we are trying to make the issues that affect those decisions clear to people. And with that in mind, it's great to be chatting to the two of you who know a lot more about that than I will ever know, which is great. So it's nice to feel like a total beginner again in this chair. Maybe just to kick off, we've just come through an election cycle in South Africa. With big events like that, you typically see movements in the financial markets. What have you seen, Kelin, and what does it portend, if anything, for the short term for the South African economy?
Look, I think going into the election cycle, naturally, there was a lot of sort of fear and anxiety in the minds of investors. This was touted by many as quite a pivotal election for South Africa. One of the very real potential outcomes of the election was having an effectively left-leaning, anti-constitutional coalition force coming into power, which would naturally have been quite devastating for markets in terms of what that would mean so far as our fiscal trajectory, how much debt we're borrowing, how much we're spending, and how much that is able to carry on sustainably, and what that would mean for private ownership of assets and the capital markets in general. I think what we saw actually was not widely priced in by markets, but a much more favorable outcome, which was, of course, the Government of National Unity, or the GNU, as it's been known, which is actually a combination of ANC, the largest party in the election, followed by the Democratic Alliance. And that combination is the best, most constructive, market-friendly outcome we could have hoped for from an election like this. And naturally, we've seen optimism of, one, what this means for growth. Having won the balance of power from having an opposition party forming a coalition and one who's quite market forward, naturally places a lot of impetus on pushing for a growth reform agenda, which we know our country desperately needs. And the other element that goes along with that is just what it means in terms of good governance and good policy. If nothing else, it's that government will actually be less in the way of the private sector, and actually, in a better sense, including the private sector in the structural reforms that our economy needs going forward. And so the market reaction to that has been very favorable. We've seen government bond yields rally over 1%, which is massive in government bond terms. I mean, 1 year performance on government bonds is over 13%. The equity markets followed after the government bond markets. We saw a lot of the SA Inc. Focused companies, the likes of our banks and retailers, catching some inflow from foreign investors, but also repositioning from local investors who some had taken cash out onto the sidelines in anticipation of the volatility around the election. And so, you put that all together, we've now got, one, the tail risk being removed from markets, which is the anti-constitutional force. The second thing you've got is a much more constructive growth reform focused political constituency. And over and above that, where we had seen very positive developments in terms of the current President Ramaphosa's Operation Vulindlela and what that meant in terms of injecting much needed skills and quick wins in key sectors of the economy, such as energy, logistics, and regulation effectively. That policy momentum is now allowed to continue in this environment. And so, yeah, we look forward to continuing to see what this might bring for our country. But so far, I think that the markets widely have welcomed this, and so do we.
Anything to add, Bianca?
Yeah, thanks, Kelin. I agree. I think there's a lot of optimism now after that coalition was formed. I think what I would like to add is really that when it comes to news and elections and markets, that this kind of news can create quite a lot of volatility. And I think that, maybe it's not the best to be sort of like looking at it under a microscope and saying, oh, what's going to happen next? Because that can create a lot of fear and uncertainty. And I mean, the market really did react at various points during the election period. And we saw those. I mean, I think for me, the currency was extremely volatile over that period.
Staying with market movements and volatility, because there's an interesting question there for, I think, probably every investor or anyone who puts money anywhere. And typically what we hear from clients when we try to bucket those concerns is effectively the market is down. What do I do? All right.
You do nothing.
Okay, so let's expand on the
that.
nothing. Like so you wait is what you're saying.
Yeah, I think that seeing bad news, your inclination is to say I need to sell or I need to get out of this investment. It's damaging my returns, my money. I'm losing my money. But essentially, what you do then is you do sell out and you actually lock in that loss. And human nature would make you want to buy something then that's done well, and you essentially then overpay for something else. And so I think doing nothing is actually better in those circumstances. I think a great example was COVID-19, when the market sort of sold off and people rushed to maybe sell, and they wouldn't have enjoyed all that sort of upside when the market recovered.
Yeah, I think the reality is, markets do not work in a straight line. It's not a bank account where your interest balance just increases each month. The reality is markets go in waves, but those waves generally trend up. So that's really what it looks like over the short term. Lots of sort of ups and downs, and that's par for the course. If you were to zoom out, 10 years, 15 years, 20 years, 30 years, which is realistically the time horizon that most long-term investors would have, those who are saving for retirement, those who are saving up to build a life of their dreams, those who are maybe already retired, you still have 10, 20, 30 years as your investment time horizon. And if you zoom out to markets in that context, surprisingly, it actually does look like a straight line from the bottom left to the top right. And so, as Bianca said, as long as your investment plan makes sense, so you've got the right asset allocation for your time horizon, so the right amount of growth assets, you understand that it's going to come with some fluctuations, some ups and downs over the short term, but you know that in the long term, this is the most reliable way of achieving your investment outcome, then unfortunately, a big part of it comes down to us just managing our emotions and effectively reaffirming that this is the plan that we've chosen and developed under a calm state of mind. And we need to go back to that sense of calm when markets are not calm.
So two things come to mind while you guys were talking there. And the first is, for me, something that I heard coming into the industry from very much more of a sort of technology background is markets are cyclical. They are cycles to the way that markets perform. That was the first point, and maybe you guys have something to say about that and some clarity to bring to that whole idea, because I kind of grasp it as a concept, but maybe there's more nuance to it. And the second thing is, if we were looking for the impact of emotions on how people use their money, would the crypto markets be a fantastic indicator for bad decision making? And I'll leave that. Maybe you can each take one of those.
Yeah. What one do you want to take, Kelin?
Maybe let's start with market cycles. That one's not going to get me killed by all the followers and viewers. I'll maybe leave the difficult crypto one to Bianca. So markets do tend to move in cycles. What are markets? When you are investing in markets, say you're investing in a company is a real business. It's not just a piece of paper that you own. A share is a part ownership of a real company. That company manufactures goods or provides a service which it must sell to customers, and customers must be willing to buy its service, which it can use to generate a profit and pay that profit back to shareholders. And so naturally, that company and its profits are subject to how accommodating the broader economic environment is. So do consumers have money in their pockets? Can they afford your goods and services? Can they afford your price increases that you're pushing through? Are you able to manage the costs of your workforce? Or is inflation running so ahead of expectations that your materials and your wages are increasing faster than you can increase the prices you're passing on to your consumers, and therefore the profit is the bit that fluctuates. And so that's, I think, important to understand as a starting point. When you're investing in the markets, especially in the equity markets, you're buying a piece of a company, and a company is a broader reflection of the rest of the economy. Now you need to overlay two cycles onto that. The first is the business cycle, which is what happens to economies. Economies start off effectively at a trough. So that's effectively a starting point. And as businesses start to see that, hey, it seems like consumers have a little bit more money, it seems like the environment is accommodating of my business, I can actually, if I make more goods or if I offer more services, I can sell more and therefore make more money. And so when business owners foresee that the economy is on the up and up, they will go and they will invest in a new factory, new premises, new technology, hire additional staff to go out and achieve the sort of promise or the lure of greater revenues. And it's that investment that effectively gets the economic wheel going and money starts circulating around the economy. And other businesses see this and they say, I'm going to be left behind. And so they also go and do the same. And that's the phase of the business cycle we call expansion. So in that phase of the market, things are really good, right? Salaries are going up, revenues are going up, profits are going up, the broad economy is growing. It's a very nice, easy, fair weather type environment for the average business. But you get to a point where people then start looking back and they say, I've been investing, I've been growing my business, it's been rewarding me, revenue and profits are up, I should do more of that. And so you can't have too many people all wanting to do more and build bigger and better. And so eventually that growth runs out and people have then overinvested and there's just not enough demand for all this capacity that's come online. And at that point, you effectively reach the peak of the business cycle where, profits are at their highest, but the way forward is down. And that's where you start getting into a decline, which tends to result in a recessionary environment where, as a business, you've now invested in all this capacity, but there's not enough consumers. So what you have to now start doing, you now have to start selling off non-essential businesses or closing down factories or reducing hours of your workforce. And that has then the opposite effect, where it effectively reinforces the downward spiral. There's less money flowing around the economy, there's less profits, and so people don't invest, they hold back, they conserve cash, and that's your recession. And then effectively, so it's a bit of a collapse, and then you get to the trough once again, which is you've now bottomed out, expectations are sort of basement levels, no one expects anything good will happen, until that marginal entrepreneur says, I think there's some opportunity here, and the cycle starts again. So those are the waves broadly, which are the business cycle. And what you can do is you can overlay on top of that sentiment, which is psychology of markets around that. So companies' profits will fluctuate based on the business cycle, but then how much investors are willing to pay for a portion of those profits is then a function of investors' outlook of the future and investors' fear or investors' exuberance. When investors are more exuberant and they expect good times will roll on forever, that's normally closer toward the peak of the cycle. Investors are willing to pay almost anything for good growth because they think the party will never stop. And it's at that point where valuations become stretched. And when a recession does eventually hit, those more expensive parts of the market where potentially more excesses or froth have built up tend to collapse much more than more fairly valued parts of the market. Then the opposite happens when you're at the bottom of the business cycle in the recession. People have only seen bad news and they've only seen things getting worse and worse for recent history. We have this big recency bias. And so you then don't want to pay for future uncertain profits because you think they could be lower from here, could be losses, and I'm not sure what the future holds. And so then investors tend to pay a lot less for that portion of a company's profits. So those are the two cycles which sometimes overlap and sometimes work in complete opposite directions in the market. And that's what creates all this volatility. People's outlook of where we are in that cycle and how much they should be willing to pay for companies, and constantly making that assessment.
Awesome. Thank you. Just shifting the focus slightly to where it may be argued there's actually no underlying value whatsoever. And I come back to the crypto question, just as a study in the type of psychology that Kelin's been talking about and the kind of mass hysteria around the thing and the kind of sale of these things.
Yes.
What do you think about that whole situation?
Sure. So I'm not going to pretend to know too much about crypto because I think I steer away from it for this exact reason. I think that if maybe you hadn't sort of caught that initial ride up, that it's really very, very speculative and very volatile. But yeah, it seems that crypto is a place where any type of sort of economical market news or even stylized news like something on Twitter can actually cause crypto to go up or down. So yeah, I mean, maybe that isn't even market cyclical. It's news. It's news. It's news driven.
Look, as investors for us, right, our starting point is how do we value this asset? What's the right price to pay for an asset? And that normally is the starting point of that is what is the cash flows this asset's going to produce and when is it going to produce those cash flows? And we then want to determine how much should I pay for that today if I were to present value all those cash flows. And that's where Bitcoin and similarly with other commodities, even gold, for example, could be put into this category, are really difficult for an investor who wants to know what the intrinsic value is for an asset to make sure they're not overpaying for an asset. That's always been, I think, the challenge with crypto. I think it has been a place where in times of, great economic performance, when stock markets are rallying, etc., when consumers are feeling good, it does tend to be quite correlated to that. And so it is an interesting debate around whether or not it is a sort of truly like disconnected alternative asset that is a complete currency hedge, a complete market hedge, a complete interest rate hedge. Because I think recent history, as Bianca said, has shown it actually does tend to move with what's happening in broader markets. Not 100%, but there's definitely a correlation.
And it's interesting that might be a sentiment correlation, a much stronger correlation to sentiment than it is to actually value or movements, actual, let's say, factual economic movements.
Fundamentals, yeah.
Actual facts and actual goods and services moving within an economy, which is a fascinating point and not one we have time to expand on right now. I take it that crypto is not something 10x invests in currently.
Not currently.
Which begs the question, what exactly does 10x invest in?
Sure, I'm happy to get into that. So we invest in a broad range of assets. We have local equities, local property. We have those internationally too. We also have, on the more defensive side, we have bonds as well as cash, and again, both locally and internationally, with the majority of our international assets being developed, but as well as some emerging market assets.
Just a question on like property as an investment, as an asset class. And I hope I'm saying the right thing there. But what does that actually mean? Do I own a property? If some of my portfolio is in property, and we'll get into fun fact sheets with you later, but it says property there. What am I actually invested in?
It's a great question. Yeah, because it can be confusing.
Yeah.
So yeah, we are not holding fixed property on your behalf. So that means we are not actually holding a property building, but we are holding companies that invest in properties. So they will either have retail spaces or residential spaces. And so we purchase the shares of those companies. And that's what our property exposure looks like.
So why would you not just call those equities?
So what's interesting about property as an asset class is it's almost as hybrid, right? So if you think of your spectrum of asset classes, you have in your defensive category, like Bianca mentioned, you have bonds. A bond effectively has a contractual cash flow, which is the coupon that you earn on your bond. And it's the interest you're earning in return for loaning money to a company or to a government. And at the end of so you're going to earn your interest, and at the end of the term, you're going to get your money back. So it's a contractual fixed profile of cash flows. You know exactly what you're going to get. And so you're able to price that with a lot of certainty. To a large extent, property has that. You have rental income, which is effectively contractual rates, and you tend to have escalations contracted within those lease agreements. So it is very much like a bond. However, on the other side, you have an equity. So why isn't property just an equity? With an equity or with a share, you are only getting profits. There's nothing contractual about profits. Profits are what's left after you've paid as a company for all your equipment, all your materials, all your labor, all your interest expenses. You've paid all your debt holders. Profit is what's left over. So it's the most uncertain cash flow you can effectively get. And so that's why investors price that with a greater discount, because it's much more uncertainty. So where property brings in elements of equity is the profile of your cash flows can change for two reasons. One, the vacancies in your properties can change. So you could have more empty properties than you expected, or you could have your properties being so full that you're able to actually go and increase your rents beyond what is effectively mandated in your lease agreements. When it comes to the renewal cycle, you can renew at even higher rates. So it's the uncertainty of the escalations or negative rental reversions that you'll get on the escalation is where you get an equity-like element on your cash flow. And the second is actually the value of your properties. The value of the properties you own can also fluctuate based on what interest rates are and what the market's willing to pay for those properties. In a growing area, the growth of a property can be quite favorable. So you've got property that sits in the middle of bonds and equity, making it a bit of a hybrid instrument. And so that's why it's in its own sort of asset class, very specific characteristics.
So just sort of drilling down on that, on the similarities between bonds and property. What happened to both of those as asset classes during COVID? Was there a movement in both, or either that could you correlate the two? Because suddenly people were leaving there weren't people in offices, leases were being broken, and at the same time you had the mass stalling of national economies, which I would imagine didn't do wonderful things for bonds. I don't know, I'm asking. Was there, or what did we see there?
So I think COVID was like a really interesting scenario. So there were two opposing forces that had happened. So in response to the crisis, where the entire economy came to a standstill, central governments around the world, and particularly the US being the sort of the bellwether of the rest of the world, cut interest rates down to zero and injected money into the economy through fiscal measures to stimulate the economy. Now, when you have interest rates reducing, that in all scenarios, other than a hyperinflationary scenario, is very positive for bonds. When interest rates come down, the price of bonds go up. So bonds did very, very well in COVID as interest rates were cut down to zero. Properties, on the other hand, which would ordinarily also do really well in that scenario where interest rates come down to zero, because they are valued similarly to a bond, priced very much an interest rate sensitive asset class. They would also do well in that scenario. And so they did get some benefit from negative, from zero interest rates or the reduction of interest rates. However, the revenue that those companies earned was significantly reduced for the factors you've mentioned. Many companies employed work from home policies, canceled leases. So you had extremely high vacancy rates within particularly the commercial and office property sector, and where those property owners were trying to fill up those vacancies or even keep existing tenants, those lease agreements were being written at significantly lower rentals than in the past. And so whilst the interest rate that those cash flows were discounted with went down, and so that should increase the value of property, the actual cash flows went down by significantly more than the benefit of the reduction in interest rates. And so those asset classes diverged in the COVID pandemic.
Right. So does this now bring us full circle back to what Bianca was talking about with defensive assets? So in the case of all hell breaks loose, bonds are safe.
Safer.
Safer, right.
Correct, as well as cash. So they sort of have have known to have sort of more stable returns over shorter time frames, whereas something like equity and property can be extremely volatile. And that's why those are known as growth assets, because they can be very volatile in the short term, but over the long term, their graph, as Kelin mentioned, does go sort of from the bottom left to the top right.
So interesting that you use the term growth assets. So it's not only assets that grow and markets that grow, it's human beings that grow. And as we grow, we go through different life stages and we need different things, right? So we need different things from our money. We need different things from our investments, right? How do you think about the different life stages and the different needs people have and what they should be doing with their money, or maybe not should be doing, but what are some of the key considerations that people need to take, to think about as they get older?
Sure, I'm happy to kick us off, and then Kelin can fill in the detail. But I actually read something today which said that time is our best asset. And so that makes me think of your question, because really we need to understand whether we have time on our side, whether we have, we're 20, we're really young, it's going to be maybe, 55 minus 20, 35 years until retirement. We have time on our side and we can take a more long-term approach, which would lend itself to more risk in our investments. Whereas as we move towards retirement, we look at de-risking our investments and trying to preserve our capital for when we do retire. We'll no longer be having an income and we actually need to start living off our investments. And so that's where growth and defensive really comes into play. So when you're younger, you can look at having a mix of more growth assets. You still want a defensive component there to create some sort of stability, and diversification is obviously a benefit. And as you move, again, as I said, closer to retirement, you would sort of change that mix. Something that 10x does. So we have portfolios and they are on a risk spectrum. And if you are younger, you would go into the most high risk. And then as you become older, you would go into a moderate risk and finally a low risk.
And not just us, but pretty much every investment manager would have some similar type of strategy, right?
True.
Yeah.
Yes.
Anything to add?
No, I think Bianca summarized it perfectly. It all comes down to your time horizon. If you know your time horizon, then your time horizon should determine what asset allocation you have. So how much growth assets and how much defensive assets, and the rest will follow. Maybe just to elaborate on why we favor growth assets for the long term for investors who've got time horizons, 5, 10, 20, 30 years into the future. The primary reason is our goal is not just to generate returns for investors. Our goal is to generate above inflation returns, because if you're just keeping up with inflation, you're actually not getting wealthier in real terms. So we need to beat inflation by a healthy clip to make sure our investors are actually gaining real wealth. And so, for example, in our flagship portfolios, we're aiming to outpace inflation by an extra 5.5% per year. So if inflation is 6.5%, the portfolio will do 12% effectively. That's more or less what we're targeting. And over the long term, it's growth assets like equities and properties that have historically been the only asset classes that have been able to reliably and consistently deliver those kinds of returns. And maybe just also put some color on it in terms of where risk sits relative to your time horizon. So if you invested in the stock market, you were to go and buy the JSE All Share Index. If you were only invested for one day, there's a 50-50 chance that you make money. So 50% chance you lose money. It's a flip of a coin. Super risky. If your time horizon is one day, you absolutely can't afford to do that. If your time horizon is 1 year, well, there's about a 33% chance you'll lose money. So a 1 in 3 chance you'll lose money. If you stretch that out over 10 years, there's a 1 in 10 chance that you'll lose money. If you stretch it out over 15 years, 0% chance you'll lose money. So that's in absolute terms. In inflation adjusted terms, there's no assets that can compete with equities and properties over the long term.
You mentioned something in a webinar we did a while back, specifically concerning living annuities, and I'm going to jump into this now in the conversation because we've got here. When it comes to people who are wanting to retire and who are wanting to live off of their investments, it seems there's this kind of golden equation that on the one side you have the drawdowns, the income you effectively take off of those investments, you have inflation, and you have the fees you pay on those investments. And on the other side of the equation, you have the return on those investments. In other words, what your investment manager the returns they can generate for you, right?
Correct.
Does that
Yes.
sound, yeah. And sort of balancing that equation is the key to never running out of money.
That's exactly it. I mean, we're not geniuses. We didn't come up with this. Actually, rich people back in aristocratic times came up with this. They effectively never ran out of money. And how, you might ask? Well, very simply, they just only lived off the interest. They never touched the capital. And so that's exactly the same concept that underlies the golden equation. So long as the returns that your investments are generating are sufficient to keep up with inflation and how much you're drawing down, and taking into account the fees you're paying, your capital would never be touched in that scenario, and you would never run out of money.
That seems quite tricky, though. I mean, it's like a balancing act. And
Correct.
I think what I would want to bring attention to, though, is sort of in that equation, there are only two factors that we can actually control. And so I guess it's important that we control for those.
And what are those?
Those are our drawdown, so how much you choose to pull from that investment to live, as well as the fees you're going to pay. And, both of those are going to erode the balance. And so controlling those are important.
Absolutely.
And it's yet another reason why you want your returns, as you mentioned, to beat inflation by a healthy clip as an investment manager, because you're wanting to take into account the fact that there are other factors affecting investors and what they can do with those returns that you are generating as the investment manager, right?
Absolutely. You've got a life to live, right? So that the reason for investing is to achieve your life goals and support your lifestyle. And as your lifestyle increases, the cost of medical costs go up, the cost of food go up, the cost of fuel goes up, cost of education, if you do a holiday, those costs tend to go up. Generally, costs go up. That's inflation. And if we can't keep up with inflation at the very least, it means your lifestyle is going to be diminished with each passing year.
So coming back to sort of life stage investing and what people do with their money at different points in their lives, something that you hear hotly debated around braais and in coffee shops all around this country is should I buy a property? If so, at sort of what stage? And isn't that money perhaps better invested in growth ETFs? I rent for, my life and see if I can get a better return with high growth assets. Now, I don't know if that's a good line of thinking or if I've even structured the question correctly, but I would imagine it has a lot to do with the way you want your life to turn out and the other factors that influence why you're buying the home in the first place and maybe a space for your kids, etc. But to bring it back to sort of put a point on the question, property investments versus things like high growth assets versus retirement investments. How does one think about these things and at what stage of your life do these questions become really, really important?
I think, as a starting point, I would say your primary residence, so that's the home or the property that you're buying for you or you and your family, that should not be seen as an investment. Is the starting point, I would say. That's very much a lifestyle decision. And so there it should be considered very much in terms of what do I need for, a healthy and comfortable life? How many rooms do I need? Do I want a garden? Is this an area that I'd be happy for my kids to, play in the street? Those are much more important factors than whether or not this is going to be a good investment. And so how you combine the lifestyle aspect with that is really looking at affordability. Is this at an affordable price point that I can that I can afford to cover these lifestyle goals I'm trying to attain? And can I do that at an affordability point that doesn't jeopardize my long-term financial plan, which is, can I still keep how much I'm saving for retirement on track? Can I still keep how much I'm putting away into emergency savings on track? That's a much more, I think, healthy way of framing it. Because if you're looking at your primary residence just as an investment, you might not be making a choice that's necessarily right for your lifestyle. Probably the best value is maybe somewhere in the Johannesburg CBD, but where buildings are hijacked and there's a good chance your car's going to be chopped up on the corner. I say that as a dramatic example, but if you really wanted the best investment returns, potentially that would be like the biggest source of value you would find, right? Doesn't necessarily mean it's a place that would necessarily fulfill your other lifestyle goals. If you look at property now as an investment, so your primary residence is sorted, and now I want to look at other aspects of investing your wealth. There's not one solution. Some people want property, like physical property in their portfolio. Some want just financial investments. Some of the biggest considerations with investment in property, so this is property purely for investment's sake, is that this is a real asset in the real economy, which means it is not just passive income like people think. You don't just hand over a check and then checks come back to you in the mail every month. There's real world things that happen. You need to slap a new coat of paint in, a geyser bursts and the ceiling boards are now damaged. You need to get insurance out, and you need to maintain your gardens. A tenant doesn't pay you rent for several months. You now need to go through an eviction process. There's all of these real world things that require your time and your energy, as much as it can be a good investment. And so I think beyond just the numbers, one should also think about whether they want a hands-off investment that's going to be working for them, compounding while they sleep, where they literally just have to sit back and wait for the returns, or do they actually want an investment that requires more hands-on engagement from them?
So Bianca, Kelin mentioned that there's, the decision you have to make with a lifestyle asset like that is, have I got the price point or the cost correct such that I can maintain my other investments, keep my retirement on track, emergency savings, etc. How do you think about that ratio and what's healthy?
Very, very good question. And I think Kelin made a great point, because obviously if that is a lifestyle asset, you're going to be paying most likely a bond, which comes with interest payments, and you aren't going to be generating revenue on that. So really it's just going to be monthly payments. And you might want to weigh up the benefit of sort of that interest payment versus what you could pay to rent, and possibly put additional money in ordinary sort of RA retirement style product. So I think it's definitely that kind of trade-off that you have to look at.
And what's too expensive for a property? Like, how do you even think about that?
Look, in general, back to the foundational principle, is it something that if you were to go and make that purchase is going to jeopardize the rest of your financial plan? So long as it's not pushing out the rest of your financial plan, I don't think you have to get too finicky. Look, if you want to narrow it down to ratios, in general, one should never be spending more than a third of their income on servicing debt for a property. That's generally sort of the upper end of what you want to be contributing to a property. But similarly, that's also the upper end of where most financial institutions would assess your affordability in terms of advancing you a loan. So that tends to be the upper bracket.
But you're never also paying
but you don't
just
necessarily want to go there. Exactly.
You're also paying upkeep on the property.
Correct.
You're also putting a lot into that property every month in terms of, that potentially would be covered by a landlord or, in another situation.
Maintenance, rates and taxes. Yeah.
Right. Insurance. So, and these are must-haves. You must pay these things, otherwise you're not going to live in that property. So it's interesting that you say a third, and yet I think the reality for many people is that it's significantly more than that when it comes to the property itself. Like, they've maxed themselves on their bond, but they are now paying more than they thought or budgeted for.
Yep.
And then what suffers is the stuff that you need for later on in life.
Probably the other savings pots. Yeah.
Yeah. Because and then a child comes along, or something untoward happens, and suddenly money that was earmarked for those types of investments, for discretionary investments or for a TFSA or whatever, suddenly is now not available, right? And then the rest of the plan gets very wonky in sort of the middle stage of life.
And look, we've just come out of a scenario where in the lows of COVID we had the repo rate at 3.5%, and it's now sitting at I think it's 8.25 is where the repo rate is now. That's a significant increase in the debt servicing costs for your home, which is also something that someone should take into consideration when buying a house. It's not just the interest rates that you're seeing on the tin when you take out that loan, but those interest rates could vary in time, could be higher. And so you need to make sure there's room in your budget in the scenario that interest rates did eventually grind higher, that you'd still be able to comfortably afford the house. So build in that bit of fat. Don't do yourself a disservice and stretch yourself to the max and leave no room for these factors that are outside of your control to happen.
When we think about investing, you often hear terms in the industry like discretionary investments versus retirement investments. And I heard, Kelin, you describe the tax-free savings account as a kind of new kid on the block when it comes to a place that people can put their money. And I'm not sure that the majority of South Africans even understand how that mechanism works and what's important within it, tax considerations, these kinds of things. So maybe just a dive into that and an explanation around what a tax-free savings account actually is.
Sure. I mean, a tax-free savings account, it's an amazing instrument that was introduced by National Treasury in 2015. And surprisingly, there aren't a lot of South Africans using it. And I'd really encourage people to go and explore this. Effectively, what this allows you to do is it allows you to invest and grow your money tax-free. So what does that mean? It means no tax on any interest income that you earn, no tax on any dividends that you earn from the companies you invest in, and no tax on any real estate property distributions that you earn. Now, why does that matter? People know that the impact that fees has on your returns, right? Saving 1% in fees would mean you would have 30% more money in 30 or 40 years' time, just 1%. If you actually look at tax, and if you were to ascribe, interest, income, dividends, withholding tax, and property distributions, for someone who's, at the top end of the tax bracket, that tax drag would equate to about 1% of your money that you would lose to tax leakage. So by not paying tax on the growth of your investments, you're actually able to compound at a faster rate. And by saving that 1% in tax, you too could have 30% more money, over a space of 30 to 40 years, which is super powerful. So yeah, that's a tax-free savings account. There's a couple of, T's and C's, but basically you can invest in whatever type of investment portfolio you like. You can invest 100% offshore. You can invest in a balanced portfolio that combines stocks, bonds, property, and cash. If you wanted to be super conservative, you could just put interest-bearing investments in there. But it's really just this vehicle that allows you to save in your discretionary capacity, no tax.
So Bianca, you manage a portfolio at 10x. What would you suggest the average South African thinks about in terms of a tax-free savings account portfolio? But also, what do they need to think about when it comes to contributions and things along those lines?
Sure. So first off, I think that a tax-free savings account is a great investment product. I do think that it should be considered with an RA. So I don't think you should be sort of selecting a tax-free savings instead of a retirement annuity. I think both have a place in one's portfolio. And what you can do is, so as Kelin mentioned, there are some T's and C's. So there are some limits. You are allowed to invest 36,000 Rand per annum into your tax-free savings. And that's a lifetime limit of 500,000. After that point, there will be quite significant sort of tax penalty. So I would suggest that you don't go over that. But I mean, even contributing, if you couldn't make 36,000 an annum, which is 3,000 a month, even just starting with 500 Rand a month into a tax-free savings account it could work. And what I actually wanted to say more importantly for me is that because there is this tax-free element on the interest as well as the dividends and growth in that, it's what you really want to do is you want to look at something that is going to produce the most growth. So if I was looking for example, some way to put some money for a car in the next year, I actually wouldn't use my tax-free savings account, because what I want to do is I want to take money that I have and put it into the tax-free saver and put it there for as long as possible so that I can get the benefit of that tax-free element in the future. Because once you sort of put money there but then pull it out, that will eat into your lifetime allocation and you can never get that benefit again. So ideally, this isn't somewhere to park emergency funds, short-term goals. This has also got a sort of long-term time horizon on it. And growth assets.
So if I think about a TFSA and I think about investing in one on behalf of my child who's 2 now, I max that out maybe around him being 15, 16, okay? And I think about the compound interest that I would get between years of his life, 20 and 30. And then I think about what that would be if it remained untouched between 30 and 40. And then I think it would be a life-changing amount of money by the time he's 40, 45, probably, buy a flat, buy a car, these kinds of things. So for me, what I pick up in the conversations around a TFSA is, firstly, the tax-free element is fantastic, because if I decide to pull that out at any point, I'm not going to be taxed on any growth within the investment. But secondly, the fact that when you pair that with the compounding that's possible, if you leave that money for a longer period of time, and suddenly now it's a really, really big amount of money, and you're pulling it out and you're not getting taxed, which in any other investment, a unit trust, or even your salary or whatever, you're going to pay tax on that, right? Any income that you get, you're going to pay tax on. So that's quite a powerful thing, if left for the long term,
Yes.
which I think is the point that you were making, really.
Yeah,
Cool.
I mean, a concern for me, and this is someone close to me in my family, they're putting their tax-free savings in a fixed deposit, and you can, but I don't think you'll reap as much benefit if you could put it in something more riskier for a longer term.
So why do people do that? Why do people put money in fixed deposits? Is this now a legacy banking issue? Like why is that?
It's exactly right. So
Yes.
there was a lot of lobbying when the legislation first came into effect, and initially it was only banks that were allowed to offer these tax-free savings accounts. And the investment industry had to work really hard to allow the National Treasury to extend the permissible investments to investment accounts and not just a fixed deposit or savings account to the bank. So I think one, there's been some very specific interests. The other has been, I think, unfortunately, because of the name, when you think savings, you think putting money in a bank, right? It's just an association. You don't necessarily think of investing. And so that's really been the history of it. But Bianca's point is spot on. A tax-free savings account is to grow your money tax-free. when do you pay tax in investments? You pay tax on the growth of your money. So if your money is not really growing, you're not really getting much tax benefits. And so that's why you want to, really put a growth engine in that tax-free savings account that is going to compound for you, because it is a long-term investment and you've got that time to just let it do its work. And so, if the other thing to say around, interest income within a tax-free savings account is there are plenty of other accommodations within the tax legislation for earning interest income. The average person is allowed to earn 23,800 Rand per year of interest income tax-free, right? That's a lot of money. If you were earning a 10% interest rate, which is, really good at a bank, you would need, about 240,000 Rand invested before you were even going to start looking at interest income tax. So use your other tax benefits that are available to you. But for your tax-free savings account, you really want to think about growth investments.
But then there's also the hidden inflation number, where you now have to consider that the growth on that money is also subject to degradation over time in the form of inflation, right? So your buying power on that is not the 7 or 8% that you might earn on the fixed deposit.
Well, exactly. That's the biggest risk with a fixed deposit. It's that it's fixed. It doesn't move around if inflation moves around, whereas growth assets are built to earn above inflation returns.
We often hear the phrase offshore investments, right? And again, I come into the investment industry and I hear this phrase and I kind of can get a sense of, that the term means, in my personal capacity, getting exposure to overseas markets. Okay, but is that what it is? Is there something more to it when we talk about investing offshore? And again, what are the considerations that people need to keep in mind when we think about offshore investing?
Sure. So for me, there are two clear paths for offshore investing. And one is really whether you want to do that using our local currency, ZAR, or you already have some sort of offshore currency. So in the instance where you have ZAR, it's likely that you're going to be buying into a fund that is a local-based fund, which will then, do all the sort of currency conversions and take your money offshore. The alternative is that you take offshore currency and you go directly into offshore assets. What we do at 10x is we do that first leg for you. So we're a ZAR-based investment manager, and we'll take on ZAR and we'll convert that into an offshore investment on your behalf.
So if you think about some of the reasons why people invest offshore, just to sort of take a step back, I think it's probably three reasons. One is people want to diversify. Okay, they've got a lot of exposure to South Africa. Your job is most likely, in South Africa, a function of the South African economy. A lot of your investments, your retirement assets, 65% of them at least must be invested within the South African markets. And so you naturally, your house and everything is here in South Africa. And so people want to diversify, which is always something we advocate for at 10x Investments. So diversification includes geographical diversification, so across other countries, across other markets. The second reason people want to invest offshore is to get access to industries and sectors and companies that are not available on, in the local market or on the JSE. Take, for example, artificial intelligence is all the hype at the moment. The likes of the tech companies that are pretty much only in the US. Sure, there are a few in Europe and a few in Asia, but predominantly in the US. And we've got almost no exposure to that theme within the JSE. Similarly, with things like renewable energy, there's very few access points for investors in the local market. The cloud computing, all of these sort of thematics. And so investors want exposure to those industries, which tend to unfortunately be offshore. And then the other reason people like investing offshore is the opportunity to access faster growing markets. Case in point for the last 10 years has been the US, for example. So that's mainly why people seek offshore investments. And like Bianca said, we offer a number of ways to give investors exposure to that.
And offshore investing in retirement. So is there a magic number when it comes to the ways of thinking about my portfolio? Now I'm retiring. I have my money in an investment product like a living annuity. How do I think about investing offshore?
Look, primarily when it comes to retirement, one needs to think about matching their income to their expenses. If most of your expenses are in South Africa, right, your housing, your food, your transport, your living expenses are in South African rand, that's the currency that you need your income to come from. And so there you want diversification, but you don't want to take on too much currency exposure. You still mainly want to have rand-based assets generating income to pay for your liabilities, which are expenses. But there's many scenarios where people have most of their expenses being overseas. So some people in retirement would, spend a lot of time traveling the world, or maybe they've got kids and grandkids in other countries. They go spend a couple of months a year, in the UK, in the US, in Australia, etc. There, a big portion of your expenses are actually not in rands, they're in hard currencies. And so similarly, following that concept of matching your assets and liabilities, there you would naturally want a bit more offshore exposure to get your income in hard currency, so that you're always matching and not going to be sort of taken for a ride on the currency. But that's when it becomes, for a rand-based investor, that offshore component, whilst is good for diversification, it's useful up until a point. Beyond that, one needs to consider that you're getting the returns of the offshore market, so whatever assets you buy in offshore, whether it's stocks or bonds or property or combination, so those have their own set of returns. But because you're drawing those down in rands, you now also have the currency impact, and the currency has its own sort of volatility associated with it. And sometimes, if the currency is weaker, so if the rand depreciates against the dollar, the pound, the euro, and the offshore returns have been stable or strong, then the rand can actually add to your returns, which is a massive sort of tailwind for investors. But the opposite can happen too, where your investments might be doing well, but the rand can actually strengthen significantly from the position which you bought, and that can offset your returns. And then on the other end of the spectrum, you can have offshore markets effectively experiencing losses, and the currency strengthens, which makes the currency a double whammy. And so the range of return outcomes, when you overlay that with currency for a rand-based retiree, becomes just a much more important consideration to make sure you can stomach that volatility. If you have a low drawdown rate, then you're less sensitive to that. But especially if you have a high drawdown rate and rand-based expenses, you want to be measured.
All right. And Bianca, how do you think about that from a portfolio management perspective? We have a lot of clients with living annuities who have offshore exposure. How do you think about how much offshore exposure they should have or do have? And
I don't actually call. I'm sorry.
That's perfect.
Yeah,
That's perfect.
no. I mean, I don't know how I can segue into this, but I mean, I just want to pull it away from living annuity for a little bit and say, even sort of pre-retirement, I mean, what Kelin described can be quite daunting for a sort of retail investor, and you're asking us, what is the magic number? And I'm just thinking, an ordinary consumer might not have that kind of insight. And so I think there are two things. One, the regulation for pre-retirement products will constrain us to 45%. But then on top of that, the best thing maybe to do is invest in a balanced fund where a fund manager will have those kind of expertise, and they can define that number in the portfolio, and they'll know the sort of interplay with that number, as well as the currency and local assets. And they sort of put that puzzle together to help you get the outcome you need for retirement. So maybe that is the best route if you don't necessarily have the expertise to define what that percent should be yourself.
Correct. So in our investment process, right, we would always start with the outcome. So what is the outcome that the investor is looking for? What is the return objective? Maybe it's inflation based. Maybe there's a benchmark that's an equity market or whatever that we're trying to target. That's the starting point. So what return is the investor signing up for and aiming for, and what do we need to deliver? And that then falls into our investment process, where in our asset allocation, Bianca and her team are scanning all asset classes, stocks, bonds, property, and cash, local and international, to determine which asset classes should be combined and what is the optimal way to combine those to make sure we can reliably and consistently deliver on that outcome. And so that's where, there is a lot of value in trusting your hard-earned savings to an investment manager who lives and breathes that every day and explicitly considers your best interest in how they manage the assets. It's not common that we all have the answers as the average consumer.